Okay, yeah, I think AI has been a real feature in capital markets over the last couple of years, and really driven by the spending of the major kind of hyperscaler businesses in the US. So Meta Platforms, Amazon, Microsoft, and Alphabet in particular, who've been investing in this new technology. But actually, they've also, at the same time, while they're doing this investment, they've seen huge growth in their own revenue and profitability and cash flow. And that's what's been truly exceptional about the US market. It's not the economy or the wider share market, it's actually these big companies that continue to be incredibly profitable because their core business of providing cloud infrastructure services or search in Google's case, or those core businesses are so profitable and growing so quickly, as Meta, for example, are taking share in advertising and monetizing WhatsApp in a way that they've never done before. So these businesses are extraordinarily profitable, growing very quickly, demonstrating really strong free cash flow growth. Return on equity for these companies in the high 20s versus 6% for the rest of the US market. So genuinely much higher profitability, much higher return on capital, much higher cash flow. But now they're investing in this new platform of computing in AI. And the question is, can they sustain those returns on capital into the future in the way that they have done so far? The honest answer is we don't know, but so far they have actually shown incrementally higher returns on capital in the most recent set of results, and that's probably what's continuing to drive their share prices higher. So fascinating space, and there's going to be lots of developments over the next couple of years. I think there is a danger of a lot of hype around this, and how we apply the technology or how we develop applications to use AI, I think is still an open question. And that's a little bit like when we built the internet in 2000, it took us 10 years to figure out how we were really going to use it. Google didn't IPO until 2004. I think Meta was 2012. In 2009, Netflix were still doing mail order DVDs to your home. So it took 10 years to figure out how to use that network. Now we're still at the stage with AI of developing the network and building the infrastructure, the data centers and all the high-powered computing that we need to then subsequently develop these applications. And I think that's the bit that's going to take time. And the big question is whether the companies that are deploying all that infrastructure can continue to earn the high returns on capital that they're earning today. If they don't, then I think there's a big challenge, but so far they've been able to maintain their returns. The actual applications and the uses, I think they come along after. And there's lots of speculation about what we're going to do with it, the same way that there was lots of speculation in 2000 about what we would do with the mobile internet. Well, the reality is we did lots of shopping, we watch TV, we use maps, and we get around much more easily. Maybe it'll be drug development, maybe it'll be autonomous vehicles. These could be the killer applications, but we're still at that kind of slightly speculative phase for that. So for now, for us, we want to focus on the infrastructure winners and the companies that are building that network of computing power that can help us develop those applications in the long term. Yeah, I think geopolitics and policy settings in general have become, much more at the forefront of investors' minds over the last, year in particular, for obvious reasons. The US has had a historic advantage in innovation and in generating dominant companies within the technology sector. But they've also had institutions that were independent, and the Fed in particular, and the rule of law and the judiciary and all these things that in the headlines that we're seeing seem to be becoming under pressure. We've also got more conflict in the world than we've ever had, and more extreme political views as economies have been under pressure. And that, I think, comes into the cost of capital that we would use to apply in our valuation models. So if interest rates remain high because there's a concern around either geopolitics or independence of the Federal Reserve, or the kind of independence of these these institutions, then you use a higher discount rate in terms of how you value companies, and that could cause your valuations to be somewhat lower. So how do we look at things like that? Well, I think defensive companies with high quality businesses that can compound up your capital over time, that have actually been under a little bit of pressure in the last few years. So companies like L'Oreal, companies like Coca-Cola, Euro-Pacific Partners, or these stable businesses like MasterCard, which will continue to do very well over the long term, I think can give you a foundation of defensiveness in your portfolio that can maybe insulate against some of these challenges that are around. Yeah, we do own Nvidia, and that's partly because of the profitability, cash flow, and return on capital that company is generating. It's a small overweight in our portfolio, but as we're still at the phase of building out this infrastructure for AI computing, Nvidia, like Intel were in the PC era, are very much the brains behind that network. And we think they'll continue to maintain a very high market share within those end markets. It earns around a 60% return on capital today, and the market's expecting that to continue to be the case for a couple of years and then begin to fade. And we think that's probably a fair assumption, that it's not a situation where it's gone up like it did in 2000 with all the infrastructure companies, and then there was no cash flow and no profitability and things came down very sharply. This is slightly different because the companies that are spending on this platform of computing are very cash generative and very profitable. So the visibility on CapEx, which benefits Nvidia, is actually quite strong. So in that sense, there's good visibility on earnings and cash flow and the return on capital that the company earns. And we think that's a reasonable place to be in today's tricky economic environment.